Hello everyone and welcome to this week's FX webinar. My name is Craig Earlham, Senior Market Analyst at Oanda. Thank you all very much for joining us once again. It's been a week since the last webinar. Naturally, in the world that we live in today, it's been such a volatile week. There's been so much going on. And as I've stressed in previous webinars, it really is so politically driven right now. And the last week has been no different. I guess, where do we begin? Let's begin with the sell-off towards the back end of last week. That's what really grasped people's attention. That's what really got people worried at times, actually, with regards to the markets because of the extent of the sell-off that we saw at times. I will say again, just as a little bit of a promo, if you want to get more detail on everything that's been happening, on everything that happens in the markets, please do subscribe to our podcast. It's a podcast we do in conjunction with Jazz FM. It's called Oanda Market Insights. And there we talk about talk about the key events happening every week. Have discussions with different analysts and the presenter Johnny Hart. That's released on Friday evening, heading into the weekend. We also have a brief look at the week ahead as well. So yeah, please do subscribe to that and let us know what you think. It's all feedback welcome. In terms of what's happening last week, like I say, the sell-off, it's hard to find a specific trigger. Everyone was looking for that catalyst, that main thing that really triggered the panic. But I think, as I've alluded to in previous webinars, there's so much underlying risk in the markets right now. There wasn't that one catalyst. I think it was a build-up in lost confidence that really got things moving. It started, you'll remember, the week before with that really strong jobs report, with the Fed comments, with all the other economic data, the ISM non-manufacturing PMI hitting multi-year, if not record highs. And all of a sudden, we saw Treasury yields break through 3%. And on that, we did see it really start to skyrocket, 3.1, 3.2, 3.25. And I know this doesn't sound like a lot, but when you're coming from the kind of levels which we've become accustomed to over the last decade, these are quite significant moves in a very short period of time. What that does is that triggers some movement throughout the financial markets. It's not just specific to bond markets, because what you have to remember is, for one, portfolios tend to be balanced in a certain manner. So if you've made significant losses in your bond holdings because yields move inversely to price, so price has fallen, you have to rebalance your portfolio. So money has to come out of somewhere else to go back into bonds to make sure the portfolio remains balanced. So that typically would draw away from equities, especially when we see a sharp sell-off, not necessarily when we see gradual moves per se. The flip side to that is when people expect that these sharp moves in bond markets are going to have negative implications for other markets, they try to front run it, or they try not to get left behind. So this can exacerbate the move further. And I think we saw plenty of evidence of that. The final thing is, if bond yields are rising, then people are looking at their returns they get on equities and seeing if the risk premium is adequate. Naturally, when bond yields are low, people demand a low risk premium on their equity, so that can actually support stock prices. So when we're seeing things like quantitative easing and lower interest rates, that's why it does tend to benefit things like equity markets and other assets such as property. When yields are rising, and specifically when they are rising quickly, people start to look at the return that they're getting on the equities. And if they're gradually rising in an environment when the economy is performing well, that tends to be okay, because the stocks themselves are actually returning more cash. They're making they're generating higher revenues. They're making more profits, and then therefore that increases the yield in that manner. So it kind of offsets the rise that we're seeing in treasuries. When you see a dramatic rise in treasuries, there's not really enough time for this to be reflected. Now, we have seen big improvements in equity price and equity profits over the course of the last 10 months or so, and that's been largely driven in the US by the tax reforms which Donald Trump imposed at the back end of last year. But that's all priced into the markets now. So when we see these shifts, and that's already priced in, it's naturally quite negative. And when you're looking for the biggest areas where you will see declines, it is typically your growth stocks. So that's looking at things like tech, which is why we've seen such a movement in that space. Now, I know this isn't FX related, but you've got to remember that this all feeds into the general move that we do see in Forex markets as well. And then, so we've seen plenty of risk aversion in the markets, I guess is what I'm saying. Now, people were looking for where these movements were happening. And typically, you're looking for your risk-averse currencies. So you're looking at the yen, you're looking at the Swiss franc. And we did see some movements there, but nothing too dramatic. So that maybe suggests to people, that maybe potentially suggests that that we're seeing money come out as cash, for example, because in periods of significant risk aversion, if people expect all markets to fall, you can go to safe havens, but you can also just pull it out in cash and wait and sit on the sidelines. That is typically what you can often see. So there's signs that we may have seen some of that at play as well. But the important thing is it hasn't lasted, not yet anyway. We got through Wednesday and Thursday and we did see those big declines. We saw a few further declines on Friday, but we did start to see signs of the market stabilizing. Over the weekend, that was going to be a real test. Are people going to come back from the weekend having considered everything that's happening and decide this is it, this is when we are going to see a big correction in the markets, and decide to take it that step further? Or are they going to reevaluate and say, do you know what, this sell-off is built on nothing, this isn't a house of cards moment, this is actually a brief panic in an otherwise healthy market, and do you know what it's done is it's presented us with some opportunities. So now things start to look a lot cheaper, I'm going to get back in. We saw some stability Monday, we saw a little bit of stability yesterday, and we are starting to see risk appetite improve today. So now we are starting to see things start to improve. Hopefully we can see that continue, but for now I think market sentiment is going to remain quite fragile, and you should be aware of that in the markets. Don't be surprised if we start to see a sell-off again, if people just jump straight back on board and cause some problems. So that is, I think, the main market moving story so far that we've had over the course of the past week since the last webinar. Apart from that, there are plenty of other stories swirling around. Of course, we had Brexit over the weekend, which had a major influence on the pound and will continue to have a major influence on the pound. We saw these last-ditch efforts by the UK and the EU in Brussels to try and bridge the divides that still remain with regards to the Northern Irish border, how to get around the Northern Irish border for now, given that there is no technological solution available, and what the backstop will be in place in order to preserve that both legally, primarily legally. The EU doesn't want the UK accessing the customs union single market via the back door, not being a member but getting all the benefits. Equally, the Brexiteers don't want to be held in a customs union with the EU, which prevents them striking new trade deals, but also keeps them tied to something that they believe they voted to leave and should leave. So it's a very complicated issue. Theresa May was hoping she'd found a solution. It seems that backstop is the real sticking point right now. Again, I've said this before, I personally believe we will get through this. I think it was always a tough task to try and do it this month. I think it's probably going to be November or December at this point, but I think given that we're so close, I find it very hard to believe that we're going to end up in a no-deal scenario here. We are starting to see that reflected in markets, and particularly look at the pound, for example, but I still think there's an awfully long way to go in that. And if we start seeing some really positive movements, then I would expect that to be reflected in the pound. But we have to remember, an agreement between the UK and Brussels is not the end of it, because this deal has to be ratified in 28 parliaments, including the UK Parliament, which is extremely fractured. You've got the Labour Party, who are looking to oppose any deal they possibly can in order to drive another election. You've got the Brexiteers within the Tory Party, who are completely opposed to May's Chequers plan and will continue to oppose it till the last second. They prefer a Canada-style agreement or no deal. You have the people within the SNP, who will probably side more with Labour, and then you've got what's left within Theresa May's Tory Party, who are likely to favour her deal, but could quite easily rebel. And finally, you've got the DUP, who are propping up Theresa May's government right. Any deal means putting up any border of any kind in the Irish Sea. So extremely complex. Explains why the pound's been so volatile, and also why it's likely to for some time, but also explains why in the medium to long term I am personally bullish the pound, because I do think a deal will happen, and it's more a case of when rather than if. And I do believe ultimately it will get through Parliament, because while Labour are taking this position now in the hope that they can get another election, they will not get another election, and they will ultimately back a deal or be held accountable just as much as anyone else. Italy is the final one. They've submitted their budget today, which they will try to force through. Naturally, Brussels is going to look for some compromises because they have exceeded the budget deficit, which they previously, the government had previously agreed to, and which Brussels views as satisfactory. I've gone into the details of this before, so I won't do it again. If you want to check that out, look at last week. But ultimately, the deficit which they are looking at now is likely to increase the debt in the medium term rather than reduce it. And given that Italy's debt is currently above 120%, I actually think it's above 130% of GDP at this point, that is obviously breaking the EU's rules, and that creates both short-term issues with regards to bond markets. Fitch and S&P both, I think it's Fitch and S&P both have Italian debt rated 2 notches above junk. If that falls to junk, then that is catastrophic. We will see some major issues then for Italy if they do fall into junk territory. Just think of the years gone by. Greece, obviously the situation is different, but when they hit junk territory, then that's when the problems really started to ratchet up. The longer term, of course, is if Brussels goes too head-to-head with Italy, with Rome, and causes too much of a headache for the government, which was voted in on a populist agenda, they are giving them bait to drum up Eurosceptic support in a country which is currently pro-Euro. So, as everything, very much a balancing act. So that covers the political side. Obviously, there is one other major story with regards to Saudi Arabia, and I will probably touch on that more when we get to the Canadian dollar section, because that's the only area which we really see it have an influence in the forex markets right now. We did see it trigger some little bit of risk aversion. However, I think that it's most keenly seen in the Canadian dollar because it is a big oil exporter. It has been a major story, but it's mainly an oil story, so I don't want to deviate too much from the fact that this is an FX webinar, having already done so on the equity side while trying my best not to. In terms of the economic data this week, there's plenty to keep an eye out for, so we're not shy of more focal points. We've had some UK jobs data this morning where the key takeaway here was the higher earnings, 2.7% increase including bonus, 3.1 excluding bonus. Again, both of these easily exceeding expectations. So we saw a little bit boost for the pound earlier on. China inflation data overnight as well, causing a few worries. We've got inflation data for both the UK and Eurozone tomorrow. So that's going to be, again, another key focal point. Not in the near term, because I think both central banks have set out their stalls already. Neither are expected to actually change monetary policy beyond what we already expect in the not too distant future, and I'm talking 6 months at least. And we've got the FOMC minutes tomorrow evening. Can someone just tell me if you can hear me okay? Because I've got one person, David, telling me that there's no sound. I just want to make sure this isn't an overall issue for everyone else. Yes, perfect. Okay, so I've not just been talking to myself for the last 15 minutes. That's always a win. FOMC minutes on Wednesday evening, again, is always keenly watched, but I don't expect too much surprise in these minutes particular. Going forward, I think people are going to be very keenly interested. You've got to remember, this meeting took place prior to all the market turmoil, prior to the risk starting to spill over. The Fed raised interest rates in September. The minutes are likely to confirm that they plan to once more in December and 3 times next year, as per the dot plot that came out of the meeting. But it's the next meeting where people really want to get some insight into whether December's still as on the table as it was because of everything that's happened since then. Thank you very much, everyone, for responding, who responded to let me know you could hear me. That is a major relief. And then moving on to the rest of the week. Thursday is huge. Thursday is the EU summit. So that's when, if we are going to see a deal struck this month, it's going to have to be at this meeting. If not, then it's going to be 1 month later, around the same time in the middle of next month. Theresa May will attend. She'll give a speech beforehand, I believe, and then she will leave before the dinner, before the discussions take place amongst the EU 27. And we should hear a lot more about where we stand on these negotiations then. I do expect more drama. I do expect more media spin. But I'm hoping that come later on this week, we should hear more. So if you're trading the pound, for example, be really aware of the events of the next couple of days, because it could get extremely volatile indeed. Okay, and then Thursday we also have the UK retail sales, which caps off a week of notable data for the UK retail sales. We have to remember that I think it accounts for around a third of the UK economy at this point. Consumer spending, services sector accounts for around 78%, and I believe the UK retail sales is around half of that, maybe around a third of that. So always a very significant number, and obviously this ties into why the economy has slowed over the last couple of years. We have seen the consumer squeeze, we've seen negative wage growth for much of the last 2 years, and we have and the economic impact has been seen on the back of that. We've got Fed speeches as well, which is always worth keeping an eye on. And we wrap things up on Friday with more Fed speeches, home sales data, and GDP overnight for those who trade the Asia session in Asia. Canadian data as well. Plenty to keep an eye on, plenty to keep everyone easily amused if the politics starts to become a little bit more boring. So with that in mind, let's go and look at the actual charts themselves and see how they're looking. Euro's got quite choppy recently. We did have the break above, which looked as though we were going to start to move on to new highs. We then pulled back inside during those risk-averse markets, particularly relating to trade, and we saw that real dollar strength that dragged us back inside. We then broke below 115.50, 115, which could have been a bearish signal. I wasn't particularly convinced about this because my longer term view is more bullish, but we broke below this level, which we shouldn't ignore. We've held up and we seem to have bottomed out around 114.50, broken through 115.50 again, and now we seem to be edging higher. Very choppy, very difficult to generate a bias with any kind of conviction on this one right now. Previous levels of support and resistance, which were reliable in the past, no longer seem to be quite so much. I feel like we're just waiting for something to happen here, and markets keep getting ahead of themselves and then being disappointed. So I'm going to keep a close eye on this one. I don't really have a strong bias in the short term. I think longer term, I am bullish. I do think that this will start to move higher. But again, as always, it's a question more of when, not if. And I think if we start to see progress on Brexit, then I think the pound could drag the euro higher along with it, along with risk sentiment as well. But also keep an eye on the Italy situation as well, because that's going to be important when it comes to the euro, because rising yields in Italy, which have dragged yields higher in Greece and also Spain, has clearly contributed to the weaker sentiment towards the euro. Looking at the pound, again, we seem to be getting ahead of ourselves, but there's clearly a determination, there's clearly a desire amongst traders for the pound to go higher. We've come back towards these kind of 129s. We were holding around 130 for a while. We broke towards 129, stayed above the 61.8 fib after breaking through that falling trend line, failing to make new highs at this moment in time. But again, still plenty of bullish buyers. I think traders seem to just be waiting for that little bit of good news. If we break through 133, then I think that could be a nice little bullish signal. But at the moment, with talk still going on, particularly this week, with plenty of data still to come, which should provide intraday volatility, although I don't expect the kind of moves we were maybe seeing earlier on this year. Be very careful of the excessive volatility that we can potentially generate if things do take a turn for the worse. Again, as with the euro dollar, I have a longer term bullish bias. I do think we'll get a deal, and I think we'll break 133. And I think it sounds extremely punchy to say, but we were trading at these kind of 144 levels back in March on the belief that things were starting to make a turn for the better. Yes, we've got lots of dollar strength priced into this, but I think the dollar is going to pair that as well. So I don't see any reason why, in the event if we get a Brexit deal, we won't. I see no reason why we can't move back towards these kind of 138s. And again, beyond there, if we get this signed off through Parliament and things start to make positive progress, I see no reason why come March next year we're not trading back at these previous peaks. But again, that all does stem on progress being made which has been not been the case up until this point, particularly on the key issues. In euro sterling, again, choppy as ever, but we are just seeing this move slowly materialize. As we were saying in the previous webinar, we saw the break through the rising trend line. This is long-term sideways trending, so not the most interesting longer-term chart, but we were trading at the highs. We broke through here a little bit when we were starting to see some negative Brexit news. And then now we've come lower. We had this kind of head and shoulders setup form here, and we were talking about the fact that given a conservative price projection, which takes us from around 90 through to 88.50, then that could give us a projection back towards our kind of 87 levels. We came back here slightly short running it, but we pretty much hit those conservative possible price projection levels. Since then, we've had a bit of a correction. We've seen some profit taken. I would have liked to see it come back towards these 88.50s, 88.65s. We fell a little short around 88.25, and we have had a rotation lower. That looks quite convincing to me. So for me, I think we could potentially be heading back towards these previous lows, giving us the more aggressive price projection area around these kind of 86.50s, 87s. Again, as with everything with the pound and the euro right now, it's not volatility should be expected. So much news flow right now that seems to be taking its toll, but this is looking quite nice at this moment in time. So we'll see how we go. I'm still not expecting a break below here necessarily. In the event of a Brexit deal, then potentially that could be the thing that triggers us lower. But right now, until that happens, I'm keeping a close eye on these 86, 850s, 87s side, and then that will just keep us range bound, and that will see effectively this head and shoulders effectively play out. Aussie dollar, I really like the look of. The commodity currencies right now, I think, are by far and away the most interesting, to be quite honest. Aussie dollar, sterling CAD, I think you'll find the SEK dollar CAD less so a little bit. Kiwi dollar, really liking the look of, similar to Aussie, because we've seen this very long channel for quite some time. And I was saying in previous webinars, I was like, I'm wondering how much further this could go. We've seen such strong declines, and we've not really seen any big corrective moves, to be quite honest. And I was looking for a break potentially above the falling trend line back here around the 73s. We rotated lower, it's no big deal. We rotated lower off the previous highs, off the top of the channel, off the 55-day simple moving average, and we came back to these lows. These are longer term lows from that we marked out previously. We found some support around here, and we've seen some profit taken, and we've moved back towards this kind of 71.50 level, which is a level that we highlighted previously. I don't know why the line's moved, but basically this relates to these previous lows here. And we've come back to these levels, and we've run into resistance. I'm wondering whether that's going to hold, or whether we are going to head back towards these 72.25s and have another dig at this upside. I'm looking at the momentum indicators on the bottom, and there's nothing really on the stochastic which gives anything away. But if we look at the MACD moving averages and the MACD histograms showing a slight divergence, so potentially a sign that the trend is starting to wear a little bit thin. If that's the case, I would like to see a rotation lower and a failed low. So if we fail above these previous lows, then that could be a nice indication. And then you're looking for further confirmation signals. So that would be a break through the previous high. It would be a break through the falling trend line, through the moving averages. And then things could start to look nicely bullish for the Australian dollar, US dollar. In the meantime, if we break through these previous lows, then again, it's about looking for those previous lows again to see where we could potentially find some support. The initial one that stands out comes around here, around the 69.75, 69.50s as prior areas of support, and then below here again you'd be looking at 69 and then 68. But I'm not convinced we're going to get that far, to be quite honest. As I said, dollar CAD's looking a little bit choppier, but more gradually edging lower. I've moved the top of this channel from around here to around here because we'd had one breakout here which I was willing to overlook. I'm not willing to overlook a couple of breakouts, And if we add the trend line now to the top of these previous points, you can see that it's probably much more accurate reflection of how we're trading at this moment in time. Again, there's not many major signals here. This is where the oil thing comes into it. So we saw a little bit of softness here in oil. We'd seen it peak around the Canadian dollar highs earlier on this month, and then we start to see it pair some of these gains. So this is where you see the correlation with the Canadian dollar start to come quite strong. And then we saw a drop off in oil last week, and again this correlates strongly with the drop off which we did see in Brent and WTI as well. Now we're seeing a bit of weakness. We're seeing a bit more strength, sorry, in oil over the last couple of days because of this Saudi issue. So this is relating to the alleged murder of a Saudi journalist who I believe writes for the Washington Post, who was entered into the Saudi embassy in Turkey in order to get the paperwork sorted for his divorce so that he could marry his Turkish bride-to-be, and never reappeared. Now, this was seen, of course, as very suspicious. There seems to be mounting evidence that there's Saudi involvement. There was some harsh words from different world leaders. So we're looking in the UK, not necessarily world leaders, but foreign ministers in the UK, Germany, France, and Trump suggested there would be harsh sanctions if these allegations turned out to be true. Immediately, that triggered a little bit of concern, which caused a bit of a spike in oil. And the reason for that was that Saudi Arabia is one of the top 3 producers of oil in the world, and we're in a very tight oil market right now, which is why we've seen oil prices reach highs of around $85 a barrel in Brent crude, around $80 in WTI. And so if Saudi starts to take some oil offline in order to fight these sanctions, that could cause disruptions. If the US imposes sanctions on Saudi, then Saudi could stop pumping quite so much oil. That creates a shortage of supply. Demand quickly outstrips supply, and we start to see prices being ramped up relatively quickly. And that is a concern because that's the type of thing that can cause a global slowdown. Prices of oil rising that rapidly. We've seen oil price shocks many times in the past. There's plenty of experience of that. It's the last thing we want. One explanation for why Donald Trump has taken a step back in his rhetoric towards the kingdom could well be the fact that he's fully aware of this. There isn't other players out there currently who could fill the void left by Saudi Arabia. The shale industry in the US is still maturing, so they are still reliant on Saudi Arabia for pumping oil. Oil supply is already constrained because of sanctions that have been imposed on Iran, which take effect from the 5th of November, which have been imposed by the US. Then there's other issues as well. I mean, beyond this is why we've seen a bit of a corrective move in oil over the past day or so. Is that oil? The Saudi Arabia is not just a big oil partner of the US; it's also a big strategic partner in the Middle East. There's the US trying to get to grips with Iran is being aided by Saudi Arabia. Saudi Arabia put in a massive weapons order from the US, which Donald Trump quite openly advertised not too long ago. There is strong connections between the two countries, and I don't think Trump will want to disrupt that if possible. So he's trying to take a more diplomatic approach here in order to avoid the need for any form of escalation. But that initial panic did trigger a little bit of a rise in the price of crude, which doesn't currently appear to have held up. So that's one of the reasons why we've seen some more volatility in oil. If we see a break to the upside from a technical standpoint, I want to see a break through 130.50, 131 ideally through these previous highs. Not convinced we're going to see that again. I do think we're going to see a corrective move of some kind in the US dollar, which would be bearish for this particular pair. Again, that brings to 127.50, even lower 127s into view in the near to medium term. But again, still quite choppy. Again, it's kind of like euro sterling, right? The two countries are intrinsically linked, so that makes the pair sometimes a little bit choppier. Sterling CAD, on the other hand, we did see a break above that falling channel. It has stalled. with the Brexit talks remains volatile. But we have broken above, and I think that's significant. If we can see a breakthrough these kind of 173s, 174s, that's another significant move again, because we're not just taking out previous levels of support and resistance, we're breaking this 200, 233 day simple moving average band, and all of a sudden things start to look a lot better. And again, looking then at previous levels around these kind of 176.50s. But again, getting a bit ahead of myself, talking a little bit quickly, so apologies. But this is, I think, looking much more interesting now. As is the Kiwi dollar, same with Aussie dollar. It seems to be a little bit of a step ahead. We've broken above these previous lows in this case. We do look to be testing these kind of 66s. If we can break above here, this could be a good leading indicator potentially for the Aussie dollar, given that the two seem to have moved in tandem with one another. So a break through these kind of 66s could be quite interesting. Confirmation then would then be sort of around 67, previous resistance 55.89 moving average band, and then you've got your levels marked out, potential support and resistance levels marked out along here. So this could start to look very interesting. And like with the Aussie dollar, these previous lows were marked with divergences in the MACD moving averages, less so with the stochastic. So I wouldn't be surprised necessarily if this rotates low, but if it does, I'd be looking for a potential higher low. Wrap things up as ever with the yen pairs. Dollar yen's looking has pulled back quite a lot over the last week or so. We've come back towards the bottom part of this rising channel, so I'm really keen on this level here around the 111.60, 111.50. A breakthrough here I think will be potentially quite a significant move. Again, risk aversion has aided this move, but if we break through here, we're looking through the rising channel, we're looking through the 55.89 moving average, and we're really testing then that Ichimoku cloud, and a breakthrough there again would be quite a bearish signal as far as I'm concerned in the current market. So one to keep an eye out for there. The alternative is we start to rotate higher, but I think we'll have to see some risk return to the markets, because at the moment we do seem to be lacking, which is naturally favouring the yen. So sterling yen, again, as we've seen in others, we have seen a break higher from that rising channel, from that falling channel, sorry. That's stalled. We've stalled around the 150, struggling to break through that key psychological barrier through those previous areas of resistance, but we're also not coming lower. Even in these risk-averse markets, we're holding up. So this is just consolidation as far as I'm concerned. So this keeps me feeling optimistic, keeps me feeling bullish. We're consolidating in these areas. We've kind of got this own little rise, falling channel set for it here now, which I can just display for you roughly. Again, this is a very rough level, so please don't take it too specifically, but you can see this kind of flag formation here. If we break through here through the 150, I think that'd be a really bullish move. So certainly one that I'll be keeping a very close eye on. Euro yen as well. Again, I think the euro will start to move in tandem more with the pound against the other pairs. Been very choppy against the yen, been very much more prone to this risk aversion, which has seen the yen rally. We've come back towards these kind of 120, 130s, 129s. Now we're approaching like the 50 fib. We broke through the rising trend line, which was quite interesting. But again, we're trading back at interesting support levels now. Between where we are now, these kind of 130s through 128, there's so much support to be found. I'll be really interested to see if we can see a nice rotation high. If we break through there, then that would be naturally bearish. But again, that's not necessarily personally consistent with my outlook. I think we're potentially looking bullish in the longer term here. We're just waiting for risk appetite to return to the markets. We're waiting for positive Brexit news, and we're waiting for Italy to reach a compromise with Brussels. Obviously, as I said earlier, and as I always say, it's not always a matter of if, it's more a matter of when, and that seems to be the crucial thing that's really holding back the markets right now. Okay, again, apologies for running 5 minutes over. I do have a tendency to do that, but I really wanted to cover everything, and there's so much going on right now. Politics is such a massive thing. I do like to cover things in as much depth as possible. As I said earlier, though, you can subscribe to the Oanda Market Insights podcast. That can be found on iTunes or anywhere else you get your podcasts. Next episode will be released on Friday. You can also subscribe to the Oanda Market Beat podcast as well. That's one who that is done by my colleague in Toronto, Alfonso Esparza. So I highly recommend you check that out as well. The recording of today's webinar will be available on YouTube in a couple of hours. I'll post it then onto Oanda Market Pulse and on Twitter and all the other social media pages. And if you've got any questions about today or any feedback, please do let me know. You can reach out to me on Twitter. It's Craig_Forex. Apart from that, thank you very much all for attending. I hope you found it useful. I hope you've taken something away from today. And most importantly, I wish you all the very, very best of luck with your trading, and I'll catch you all hopefully again next week. Thank you.